Hi everybody, this is Gary Dean, and this is our nightly video report for Monday, April 4th, 2016. Not really much going on today. We saw a little bit of selling, but overall, the last few minutes we saw just a little bout of buying, and it brought the the S&P up a few points and only closed down 6. But as far as charts and patterns, today did absolutely nothing to give us any kind of say inside information as far as what to expect, and I'll go over that in our regular charts. But first thing, let's just go through some of the internals. This is the advanced decline. This is the highest it's ever been, and it even going back into the 2000.com bubble, going into the 2007, going through the the QEs that have been through. This is the highest it's ever been. Again, I think it's a little misleading for a lot of the, let's say, people that look at it and say that it's extremely bullish because the advanced decline line is at the highest levels. I still think it has a lot to do with just the number of ETFs that are out there, and when we gap up or whatever, they have to buy stocks. So it's not bearish, but what I'm saying is I don't think this being at the highest levels it's ever been is giving a clear picture. But in any case, extremely overbought. Taking a look at our put call ratio, you can see that we've we made it up, but we didn't get any really kind of pullback from there. It's now heading back down to where everybody is buying calls right now, so you got to be a little bit careful with that right there. And then taking a look at our bullish percent, and again, we're probably at some of the highest levels we've ever been at, and this is going through all the years that it's been covering it. But yet you can see the S&P still has a ways to go until we get into the before we're hitting all-time highs. So it's like the internals are front running this entire thing. And finally, I've been showing you this. This is the commodity index. It usually breaks first before the S&P, and you can see this thing topped all the way on March 21st and has been heading down. So eventually I think it is going to put some pressure on the indexes, but it's just a matter of when. So taking a look at the S&P, bearish divergences, overbought, nothing's really changed. We're in this resistance zone. If the bulls can push through it, then we're probably heading up to the 2104. Really, the bears, which I'll show you on the shorter term charts, need to get it through this 2044. That will probably give us a reaction trade down to the 2020 or possibly even down to the 2015. And then the real line in the sand is at the 1996 level. So taking a look at the 60-minute chart, again, bearish divergences, nothing's really changed on that. We're still trading within this rising wedge right here. We're kind of at the bottom of it, and this is really the risk of when you say trade within this type of pattern, is once we start getting up to the top, there's not a whole lot of room as far as the bulls have to be perfect, because when they break it, that's when you start to see some momentum pick up. But unfortunately, what we've seen happen is we've seen them break these wedges often. From there, find support and then cause a short covering, and we've seen it break it a few times. So, even though we're at the bottom of it right here, and they should hold, it doesn't really always mean that it's going to automatically collapse. Just because, like I said, we've seen it break a few times, but the pattern is bearish. That's probably really my main point I'm trying to make. So anyway. 2053, it seems like they're buying, the moving averages on there. So I would say anywhere between the 2053 and the 2043. This is what the bears need to get it through. Otherwise, the bulls are in control. The real line in the sand is coming down at this 2022 level right here. And, finally we have the moving average. So these are the support levels, and really the first thing that the bears need to do is break it through this low to get a reaction low down to the 2024, and then maybe down to this, the 2000 level, or where the 2009. So that's really it. We have the bearish divergences in place. 15-minute chart, they were buying the moving average. They broke through it. So again, this is what I've been showing you as far as what the bears need to push through, and that's right around that 2055. We have the moving average at 2051. It really needs to close the day below this, and we need to, that's where you would get a reaction trade. But just a 23% retracement, it brings us down to the 2016. So there's a lot of room to go just to get to a bare minimum type of retracement, and that makes things a little risky. So Dow Jones, you can see we made it to the 78% retracement. The NASDAQ, we almost made there. It still has a little more room to go. But, that's really about all I had today. I didn't really do anything as far as changing the dynamics of anything. We're still probably at some of the most overbought levels I've seen since this rally started, since 2009. But the bulls are in control until we see some support levels taken out. So with that, have a great night, and I'll talk to you guys in the morning.